Hello everyone, I am Dr. Madhavi. Today we are discussing about one of the topic in financial management, capital budgeting. So capital budgeting is generally used for investment decision making. So it is a long term investment decision making. If we want to invest huge amount of funds in any business, we have used this technique. Actually, this capital budgeting is used for expansion of business, reconstruction of the business, and replacing old machinery, and also diversification of the business. So whatever the decisions we want to take regarding the large investment, we are using this one. So this capital budgeting have majorly two types of methods. Number one, traditional method, and number two, modern methods. So in these traditional methods, we are not used time value of money, we have to use existing returns of the company. So these are again two types, payback period and also accounting rate of return. So if we have considering the payback period, in this payback period, how many years we are able to recover our returns from the business. Suppose if we have taken two projects, so one project have getting 6 years of time to recover the returns and another project is getting 3 years for recovering our returns. Apart from these two, we have selecting project 2 because the returns of that project have recovering within 3 years. That's why we have choosing project B based on the payback period. So that is the payback period method. And coming to the accounting rate of return, so this is to be used for identifying the profitability of the business. So profitability is consisting of which project have more profitability, we have accepting the project, which project have less profitability, we have rejecting the project. So for that we have using a small formula, that is average rate of return is equal to average profit after tax by average investment. Suppose if we have taken 5 years of profit, we are averaging 5 years of profit and we are taking average of investment, that is considering investment divided by 2. This is the formula we have used for accounting rate of return. So these two methods are traditional methods. And coming to the modern methods, we have 3 modern methods are there. In these 3 modern methods, we are considering time value of money. So time value of money means if we have investing 1 rupee today, how much amount we have returned after 1 year, it is to be taken into consideration of time value of money. So in these modern methods, we have considering time value of money for taking the decision in the large investment. So these methods are divided into 3 types. Number 1, net present value. Number 2, internal rate of return, and number 3, profitability index. First one is net present value. So this is the method which we have taken the difference between present value of cash inflows and present value of cash outflows. If cash inflows is positive, we have accepting the project. If cash inflows are negative, we are rejecting the project. This is the parameter which we have used in net present value. So this is the method which we are used exclusively in different projects. And coming to the internal rate of return method. This method is called as trial and error method. So we have to meet our returns through the trials of our returns. So when we have meeting our required rate of return percentage, up to that we have calculating this trial and error. So when NPV, net present value, is 0, we have to be taken this trial and error. When NPV is 0, that percentage is treated as internal rate of return percentage. So if internal rate of return is more, we have accepting the project. If internal rate of return is less, we are rejecting the project. This is IRR. And coming to the next one, profitability index method. So profitability index method is used the profits which are considering time period. So here in this method, we have using the formula present value of cash inflows divided by present value of cash outflows. If PI, profitability index is greater than 1, we have accepted the project. If profitability index is less than 1, we have rejecting the project. So these are simple 5 methods which we have used in the capital budgeting. So these methods are to be considering for decision making in financial management for long-term investment. So this is one of the technique in financial management. And coming to the next one, working capital decisions. So next one in financial management is working capital decision. So in this working capital, it is used for short-term investment decisions. Before we have discussing about long-term investment decisions. Now we have discussing about short-term investment decisions. So for this we have used working capital. So working capital is to be calculated the difference between current assets and current liabilities. So current assets means the assets which are converted into cash within 1 year, that assets are called as current assets. Current liabilities means the assets which are converted into cash within the assets which are converted into cash which is called as current assets. Current liabilities means that assets which are repayable within 1 year, it is called as a current liabilities. So the difference between current assets and current liabilities is called as a working capital. In our business day-to-day operations, working capital plays pivotal role. So we have to maintain adequate working capital in our business operations. Adequate in the sense, how much of amount required for meeting our day-to-day expenses. For example, purchase of raw materials, payment of wages, payment of all other expenses, and for meeting the other day-to-day events, we have used this expenditure. The total amount is called as a working capital. So for estimating this working capital, we have using working capital decision. So how we have estimating this working capital means, we have taken into consideration of time cycle of working all current assets. For example, raw materials. So raw materials, how much time is taken for converting into the goods, and also another one is the debtors. In the debtors, debt collection period we have taken into consideration. So debtors means the persons who owes to the business. We have receiving amount from the debtors and we have repayment to the creditors. So we have to be taken this debtors portion. So next another one is the cash. Cash balance we have maintained in the business. And also bills receivables. Bills receivables means guarantee documents which are provided by the company to customers. So whenever we are selling goods to the customers, if that customers are unknown persons, we have receiving guarantee from them, and then we have selling products to the customers. That on behalf of the customers banker have given guarantee, so that it is called as a bills receivable. So we have taken all these current assets, debtors, bills receivables, cash in hand, cash at bank, and also the stock. So these are all current assets, and these current assets are estimated based on the time period of recovery. Debtors are, we have given credit period to the debtors, and as usually bills receivables have 3 months duration or 6 months duration. And also cash in hand, cash at bank, it is a liquid asset, so there is no time required for that. These all based on the time requirement of these current assets, we have estimating the total current assets value in our business. And also current liabilities. In the current liabilities component, one of the current liabilities is creditors, another one is bills payables and bank overdraft. So creditors are the persons who owes to the company. We are buying raw materials on credit basis from the suppliers are called as a creditors. So we have receiving some time duration for repaying that amount to the creditors. The time period we have considering, this time period is as usually fixed more than the debtors collection period for feasibility of business operations. So, and another one is bills payable. Like a bills receivable, if we don't know about the supplier, we have receiving credit from the supplier by issuing the bills. So, it is called as a bills payable. We are given guarantee to the suppliers for our raw material purchase. It is called as a bills payable. So, as usual, this bills payable have the time duration of 3 months or 6 months. And bank overdraft, it is a daily direction value based on our deposits. So, these three values which we have taken into consideration of current liabilities. So, this is the estimation. We have to estimate all current assets and we have to estimate all current liabilities. The difference between current assets and current liabilities are called as a working capital. So, for this working capital, we have used some additional reserve. It is called as a contingency. So, that reserve we have to be adding. Suppose, for example, in the market conditions, the price of raw material is increased. We have to bear additional amount of working capital. Suppose, if debtors are not given, that we have arising the bad debts, in that case, we have meeting our creditors within the time duration. So, problem is again occurs. Due to that reason, we have to be taken contingency reserve for meeting all the activities which are going on in the business. So, this is called as a working capital requirement. This is another decision making in the financial management. And another one is capital structure decisions. So, capital structure decision means the composition of debt and equity mix is called as a capital structure. Actually, so in the business, generally in general sense, what we have assuming that if we have a own capital, own funds, if we start the business, it will give more returns, but it's exactly wrong. Why? Because if we have used debt from the outside, we are able to increase our leverage in our business by taking in the form of tax deduction. So that this capital structure play pivotal role in the arrangement of financial sources. So, this capital structure we have to be taken the proportion of debt and equity mix. So, in that debt equity we have a long term debt, we are taken long term debt. In equity we have taken owner's capital. So, this is the capital structure. So, for this capital structure we have various theories are there: net income approach, net operating income approach, and also approach, means Modigliani-Miller's approach, and also traditional approach. These four theories which we have used for identifying the capital structure, where we have maintaining the optimum capital structure. This is another technique in the financial management. And next one is cost of capital. So, cost of capital means when we have go for the financing, we want to raise the funds from outside, we have to pay some interest or some dividend to the concerned persons. So, the amount which we have spending for raising of finance, it is called as a cost of capital. So, these have four components. Number one is cost of equity, number two is cost of debt, number three is cost of retained earnings, and number four is cost of preference shares. So, these four components which we have to be calculated, and we identify what is the minimum required rate of return of the business. So, minimum required rate of return means it is a cost of capital. So, this is another technique which we have used in the financial management. And the last one is dividend decisions. So, dividend decision means actually if company form of organization, generally dividend plays a pivotal role. Why? Because So in this dividend decision, businesses, if the company once it has generating the profits, at the end of the year, the company have to issue that profits to the shareholders in the form of dividends. But some of the companies are using that dividends as a retained earnings and reinvesting the dividends for expansion of their business and also expansion of their assets. So this, or else some of the companies are issuing dividend for generating goodwill in the market. So that these dividend decisions also very important in the financial decision making. So in these dividend decisions, we have various methods which we are used, that is Walter method, Gurdon method and Modigliani-Miller's method. These three methods which are used. So Walter is concentrate on returns, which has to be deciding whether dividend is issued or not issued. So here Walter have to be considering that the forms are divided into three types. Number one is the normal form, number two is the growth form and number three is the declining form. Normal form means when required rate of return is equal, cost of capital is equal to rate of return. It is called as a normal form. So both our expenditure is equal to our income. So in that case, the company have to decide, decided that so 50% of the amount is issued as a dividend and 50% of the amount is to be holding as retained earnings and they are used for future expansion. So and second one is the growth form. Growth form means rate of return is more than the cost of capital. That means R is greater than K naught. So in that case, company is need not to issue the dividend. Already company have a more goodwill. So that's why that company have to be issued 0% of dividend and total 100% of dividend is to be holding in the business for the expansion. If it is a growth form. Growth form indication is R is greater than K naught, that is. And coming to the third one is declining form. Declining form means R is less than K naught. Rate of return is less than cost of capital. So in that case, compulsory company wants to create goodwill in the market. Company needs to issue 100% of profits as a dividends. It is called as a declining form. So these are three types of forms which we have identifying for taking the decision whether we have issued a dividend or we are not issued dividend to the shareholders. This is another one. So these are 5 techniques which we have used in the financial management. So these are called as functions of financial management in the modern era. Thank you.